So the financial position of Watt Limited, a grocer, on the 1st of the 1st, 2014 is shown in the following balance sheet. So you have your list of assets and liabilities there. The following transactions took place during 2014. So in January, Watt Limited bought an adjoining business on the 1st of the 1st, 2014, which included buildings, €240,000, delivery vans, €42,000, and creditors, €54,000. The purchase price was discharged by granting the seller 220,000 shares in Watt Limited at a premium of 20 cents per share. In February, it says a creditor who was owed 2,500 by Watt Limited accepted a fridge freezer, the book value of which was 2,200, in full settlement of the debt. This fridge freezer had cost €4,000. In April, Watt Limited decided to revalue the land and buildings on the 1st of the 4th, 2014 at €990,000. The land element of the new value is €170,000. Now please underline the land element of the new value is €170,000 and draw an arrow down to December where you have to calculate the depreciation charge for the year. So you might forget that there is land included in that value, which we don't appreciate. So then May, we have received a bank statement at the end of May showing a direct debit of 3,600 to cover fire insurance for the year ended 31st of the 3rd, 2015, and a credit transfer received of 8,600 to cover 10 months rent receivable in advance from May the 1st. In July, it says a delivery van which cost €15,000 and had a net book value of €3,300 was traded in against a new van costing €24,000 on the 1st of the 7th, 2014. An allowance of €4,500 was made for the old van. In November, a payment of €1,260 was received from T. McDonough, a debtor, whose debt had been previously written off and who now wishes to trade with Watt Limited again. This represents 90% of the original debt, and the debtor had undertaken to pay the remainder of the debt in January 2015. On the same day, goods to the value of €720 were sold on credit to McDonough. This is a markup of 20%. In December, it says the depreciation charge on buildings for the year is to be 2% of value at the 1st of the 4th, 2014, and to depreciate delivery vans at 20% of cost per annum from date of purchase to date of sale. Okay, so what is required? So record on a tabular statement the effect each of the above transactions had on the relevant asset and liabilities, and ascertain the total assets and liabilities on the 31st of the 12th, 2014. So this is 60 marks, and you've got 27 minutes in which to do this question. Your solution should look something like this, and you'll be given in the exam gridded paper in which to do your solution. So step 1 is lay out the tabular statement. So you put all of your assets up the top here and all of your liabilities down the bottom there. You lay out your assets as following. So you've got your goodwill, 45,000, then you've got your land and buildings, 690, and then you minus the depreciation, 55,100. Then you've got your 30,000 equipment and minus 2,500 depreciation here. And then you've got your delivery vans, 86,000, and then minus your depreciation of 32,000 there. Then you've got your stock, 73,600, and your insurance prepaid, 1,000, and you've got your debtors, 52,900. Then you've got your liabilities, you've got your authorised capital, issued capital, 480, there's authorised 750 there. You've got the share premium, 75,000, you've got the P&L, 236,000, you've got your creditors, 82,300, you've got your bank, 11,900, and you've got your expenses due, 3,700. So altogether, you just list out all of your assets and your liabilities. So start recording the transactions then as next. So in January, Watt Limited bought an adjoining business on the 1st of the 1st, 2014, which included buildings, 240,000, delivery vans, 42,000, and creditors, 54,000. The purchase price was discharged by granting the seller 220,000 shares in Watt Limited at a premium 20 cents per share. So you put your 240 into your buildings, you put 42 into delivery vans and 54 into your creditors. The purchase price was discharged by granting the seller 220 shares in Watt Limited, and you look back at your balance sheet and the shares are €1 per share. So that is €220,000 into the share capital and 44,000 into share premium, because when you multiply 220 by 0.2 or by 20%, you get €44,000. So that's just a charge when you are selling those shares. Now, at this point in time, your assets and liabilities do not equal. So you've got 240 and 42, you've got 282,000 assets, and you have goodwill liabilities 318. The difference must be goodwill. So goodwill, when you're buying a business, goodwill is the established reputation of that business. Okay, so that is your January complete. So in February, a creditor who was owed 2,500 by Watt Limited accepted a fridge freezer, the book value of which was 2,200, in full settlement of the debt. The fridge freezer had cost €4,000. So let's think about this now. So the creditor was owed 2,500. So the debt to the creditor is going to reduce by 2,500. The fridge freezer had cost 4,000, so we're going to reduce that from the equipment account. Okay, so 400 has been reduced by the equipment account. We add back in any depreciation that had been charged. So the book value was 2,200. It had cost 4,000. So the difference there, 1,800, was the depreciation that was charged. So that 1,800 is included in this. We add it back in to cancel that out. So as you know, when we sell a fixed asset, we get rid of the depreciation on that fixed asset. We reduce the creditors by 2,500, and the difference between what we owed them, the 2,500, and the value of the asset that we give them is €300. So that is a profit on the trade or discount received. Either way, it's €300 put into the P&L balance there. So in the assets, you've got minus 2,200, and in the liabilities, you've got minus 2,200. So that is February done. In April, it said Watt Limited decided to revalue the land and buildings on the 1st of the 4th, 2014 at €990,000. The land element of the new value is €170,000. So you underline the land element of the new value is €170,000, and you draw that down to your December column so you won't forget to remember that 170 of the value is land and not to depreciate that. So what we do is we bring the land and buildings up to 990. So here we had 670 plus 240, that is 930. So €930. We need to add €60,000 to bring that up, the cost up to 990. We also unwind any depreciation that was previously charged on the building. So 55,100, we're going to cancel that out. So we add 55,100 back in. The total assets there then, €115,100. Now, what do we do then in the liabilities? So as you know in question 1, when we revalue land and buildings, we add a revaluation reserve into the finance by section of the balance sheet. So we put revaluation reserve 115,100. So you've got 115,100 in assets and 115,100 in liabilities. So that is April done. In May, we have our bank adjustment. So received a bank statement at the end of May showing a direct debit, not a direct debt, a direct debit of 3,600 to cover fire insurance for the year ended 31st of the 3rd, 2015. And a credit transfer received of 8,600 to cover 10 months rent receivable in advance from May the 1st. Okay, so if we're looking at May, first of all, let's think about the bank and what would happen to the bank with regards to these two figures. So in the bank, let's talk first of all the direct debit of 3,600 that came out to pay fire insurance. That will increase my bank overdraft figure. So I plus 3,600 there. Whereas 8,600 that was received for rent received, that is coming into the bank, so that is going to reduce the bank overdraft figure. So minus 8,600 here. Now, what I do now is I think about where am I going to put these two items. So if we think about the direct debit of 3,600 to cover fire insurance up until 3 months of next year, so we're doing 2014 here, so that's 3 months of next year, that means at the end of the year we're going to have insurance prepaid, which is an asset. So I already had in my assets from my balance sheet, I already had 1,000 insurance prepaid, but I'm going to have insurance prepaid at the end of the year as well. So I'm going to put the 3,600, I'm going to add that up here. Now, then I have 8,600 to cover 10 months rent receivable in advance from May the 1st. So that rent that I have received is for my tenants to pay for rent for May, June, July, August, September, October, November, December. So that is 8 months of the current year. And then I'm going to have January and February of next year already received from my tenants. So that means that I'm going to have rent receivable prepaid for 2 months for next year. Rent receivable prepaid is a liability. So I'm going to write down in my liabilities, I'm going to write rent receivable, and then I'm going to say 8,600 here. Altogether then I have 3,600 in assets and 3,600 in liabilities. So what I do then is I'm going to do my second December column. So my December column that relates to my bank statement month. Okay, so at the end of the year, I'm going to do my expenses or revenues prepaid or due or whatever it might be. So what I need to think about is what is attributable to the current year. Okay, so if we look at the fire insurance first of all, 3 months of that is for next year. So 3,600 multiplied by 9/12 relates to this year, which is 2,700. That is 9 months of this year. When I add the 9 months to the 1,000 insurance prepaid already here, that is 3,700 that relates to this current year. Prepaid is 3 months, so we have the 3,600 multiplied by 3/12 is 900. So I have 900 3 months insurance prepaid. Now you might notice that the 3 months prepaid at the start of the year was different. So 1,000 here and 900 here. How can that be? Well, as you know, car insurance premiums change from year to year. They're never the same amount, and there's lots of different factors that affect that. So just remember that that can happen. Okay, same with rates, other expenses like that, right? They do not stay the same from year to year. So if you wanted an easier way to work that out, just work out what the 3 months insurance prepaid is, and then your difference, going across 1,000 plus 2,700 minus 3,700. So what does that insurance expense that you've had for the year do to your profit and loss figure? So your profit figure will reduce because that is an expense for the business, and that reduces the profit figure. Okay, so moving on then to the months, the rent receivable. So how many months related to this year? It was 8 months that related to this year, and then 2 months are prepaid then for next year. So 8,600 multiplied by our 8 months out of our 10 that relate to 2014. So minus 6,880 from your 8,600 here, leaving 2 months rent receivable prepaid at the end of the year, which is 1,720, which is the same thing as 8,600 multiplied by 2/10. So that is your May adjustment done. So do not forget about the December column there. And sorry, let's think about, before we finish up here, what does rent receivable do to the profit figure? It increases the profit figure. So we add 6,880 in there. So we've got minus 3,700 and minus 3,700 in both the assets and the liabilities. So that is May. In July then, we have a delivery van which cost €15,000 and had a net book value of €3,000, was traded in against a new van costing $24,000 on the 1st of the 7th, 2014. An allowance of $4,500 was made for the old van. So, delivery van, which cost $15,000, was traded in against a new van costing $24,000. So the vans have increased in value there $9,000. Now what you can do there as well is just put into a bracket minus $15,000 and then add the $24,000. That's absolutely fine there as well. Now, into the depreciation of delivery vans, we are going to unwind any depreciation that had previously been charged on the delivery van, and that is $12,000. How did I get that? Well, it had cost $15,000, but the net book value was $3,000. So the difference is the $12,000 depreciation that had been charged on it. So overall here, we've got $21,000. Now, what about my liabilities? Well, how much did I pay for this new van? Okay, so the new van cost $24,000 and I got an allowance of $4,500. So the cheque for the net amount must have been $19,500. That $19,500 will increase the bank overdraft. So $19,500 goes into bank overdraft, so plus $19,500. Now, the allowance was $4,500. The van was only worth $3,000 in our books. So that is a profit on sale of delivery van. Where do we put profit on sale of delivery van in question 1? We put it under add operating income section, which is where we put any of our revenues that relate to the business that aren't sales. So that is going to increase our profit figure. So plus 1500 there as well. So we've got 21,000 in assets and 21,000 in liabilities. So that is July complete. Next we have November. So a payment of 1260 was received from T. McDonough, a debtor whose debt had been previously written off and who now wishes to trade with Watt Limited again. This represents 90% of the original debt, and the debtor had undertaken to pay the remainder of the debt in January 2015. On the same day, goods to the value of €720 were sold on credit to McDonough. This is a markup of 20%. Okay, so we'll look at the first bit first and then move on to the second. So a payment of 1260 was received from T. McDonough. That 1260 is going to come into the bank. So the bank overdraft is reduced by 1260. That 1260 represents 90% of the original debt, and McDonough has said that they will pay the other 10%. What is the other 10%? So 1260 divided by 90 multiplied by 10 is 140. So I add 140 into debtors. Now obviously I've put two figures in here, but 140, you can put 140 in there and then we'll put the other one in, or you can put them in as a total, which will be 860 in total, but 140 goes into debtors here. Now, in total then, how much had McDonough owed you? So 1260 was the 90 and 140 was the 10%. So in total, that is 1400. So into the P&L, we put 1400. So I've got 1520 there. So there's obviously another 120 that I'm going to get in the second paragraph, but you can put in your 1400 here. We can separate out this 1520 into 1400, whatever you want to do. So that's the first part done. Minus 1260 from bank, add the 140 into debtors, and then add the 1400 into the P&L, because that is bad debt recovered, which would usually go in your add operating income in your question 1. Then it says the second part, on the same day, goods to the value of 720 were sold on credit to McDonough. This is a markup of 20%. So the 720 is going to go in to McDonough. Okay, so here you've got your 720 and you've got your 140. So you can put them two figures in separately or together. I probably would suggest doing it separately in case you got one of them wrong and that you wouldn't get the total figure right. Okay, so 720 went into McDonough's account. What about the stock? So stock is going to be reduced. We want to find out what the cost price of the stock is then. So the cost price, 720 divided by 120 multiplied by 100 is €600 is the cost price of the stock. So we take €600 away from the stock there. And then the other 120 is the profit. So 120 goes into the P&L account because that is the profit increased. So in the profit here, you've got your 1400 bad debt recovered plus your 120 profit. And that is November completed there then. The last month that we have now is December. So the depreciation charge on buildings for the year is to be 2% of value on the 1st of the 4th, 2014. Depreciate delivery vans at 20% of cost per annum from date of purchase to date of sale. So what we want to do is remember, first of all, that we revalued land and buildings at the start of the year to 990, but that included 170,000 land. Okay, so what we do, we multiply that by 2%, and that is 16,400. Okay, so 16,400. So that was the value as at the 1st of the 4th. So 16,400 is taken away from the land and buildings there, so it's added on to your depreciation. So that's minus, and that is showing that you're reducing the value of the asset. And you also put that into the P&L, so minus 16,400, so depreciation would reduce the profit. And then it says depreciate delivery vans at 20% of cost per annum from date of purchase to date of sale. Okay, so a couple of things happened to the delivery vans here. So at the start of the year, we had 86 plus 42, okay, which is 128,000 here. Multiply that by 20%, and that was for the whole year. So that was 25,600. And then you have your 9,000 by 20% by half the year. So we had that from the 1st of July. So that is €900. So altogether, €26,500 is your depreciation on delivery vans, which we take away from the value of your delivery vans there. So minus 26,500. And then we also take that away from the P&L balance because that is reducing the profit figure. So altogether, we have minus 42,900 in our assets and minus 42,900 in our liabilities. So that is December absolutely complete, and the only thing that you have left to do now is to tot up your totals. So you can pause this screen now and make sure that you have all those figures there. So there was 8 marks going for the total column there in this current year in the 2015 what question, and it could be going for any figures, so it's completely random.